5 states are quietly pulling up to $4,000 or more in home equity away from senior homeowners every single year. And almost none of those homeowners realize it is happening until a bill shows up in their mailbox or the deed is no longer in their name. This is not a standard property tax situation. It is something else entirely. It is a silent equity transfer that has been operating for decades inside some of these states. And a Supreme Court decision in 2023 only put a stop to part of it. The remainder continues to this day in every county across these 5 states, and in 2 of them, the situation is about to deteriorate further. You spent 30 or 40 years working to pay off your home. The deed has your name on it. The mortgage has been cleared. You naturally assume that the equity sitting inside that home belongs to you. But the rule that determines whether that equity actually stays yours is not written into any federal law. It is written county by county inside obscure state tax statutes that were drafted before most of you were even alive. And in the 5 states I am about to walk through, those statutes still permit the government or a private investor operating through the government to walk away with tens of thousands of dollars of equity that you spent your entire working life accumulating. There is one filing available at a county or town office for under $75 in most locations that quietly neutralizes the worst of this mechanism in 4 of the 5 states I am about to name. I will tell you exactly what it is before this video ends, but only after you understand which states still have that rule written into their books and why seniors with fully paid off homes are the most exposed group of all. The rule does not go after struggling homeowners. It goes after the ones who have the most equity available to be taken. That means the seniors who did everything correctly are standing in front of the largest potential losses. Let us begin with the case that brought this entire mechanism into public view. A 94-year-old widow named Geraldine Tyler owned a 1-bedroom condominium in Hennepin County, Minnesota. She fell behind on her property taxes. The total amount owed, including penalties and accumulated interest, came to approximately $15,000. Hennepin County seized the condominium, sold it for $40,000, kept every single dollar, and gave Geraldine Tyler absolutely nothing in return. Not a refund, not a check, not the difference between what was owed and what the property sold for. The county absorbed $25,000 of her equity she had built over the course of decades, and called it entirely legal under Minnesota law. For years, courts in Minnesota and several other states held that this was perfectly acceptable. The reasoning was that once a homeowner falls behind on taxes, the entire property is forfeited, not merely the unpaid tax amount. So if your home is valued at $400,000 and you owe $10,000 in back taxes, the state could take the entire property and retain all $390,000 of your equity. And so Geraldine Tyler took the matter to court. In May of 2023, the United States Supreme Court ruled unanimously in Tyler versus Hennepin County that this practice violates the Takings Clause of the Fifth Amendment. The Constitution states that the government cannot seize private property for public use without providing just compensation. Taking $25,000 of equity over a $15,000 tax debt is, in plain terms, a taking without compensation. But here's precisely where most people stop reading the news coverage and miss everything that comes after. The Supreme Court did not invalidate property tax sales altogether. It only ruled that the surplus, meaning the equity above the amount of the tax debt, must be returned to the homeowner. So the seizure can still occur. The auction can still proceed. The home can still be lost. The only change is that the county must send you a check for whatever remains. And that is exactly where the next layer of problems begins. In Minnesota and 4 other states I am about to identify, the rules surrounding how that surplus is calculated, who receives notification, how long the homeowner has to file a claim, and what fees are deducted before any money reaches the former owner are still being worked out. Some counties deduct administrative fees of 15 to 25% before forwarding the surplus. Others require a separate court filing just to claim it, and if the senior misses the filing deadline, which can be as brief as 90 days, the surplus can revert back to the county regardless. So the federal court eliminated the most severe form of equity taking. It did not eliminate equity loss entirely. A $4,000 equity loss caused by fees, missed deadlines, and procedural obstacles is still a routine outcome in tax sales across these 5 states. Even following the Tyler ruling, Minnesota amended its tax forfeiture statute in 2024 to bring it into compliance. Surplus funds are now held in a state account, and the former owner can submit a claim within a defined time frame, but the claim form is not sent to you automatically. The county is required to notify you, but that notice is mailed to the address on file, which for an estate in probate or a senior who is relocated to assisted living is frequently the wrong address. The notice arrives, the deadline expires, and the surplus remains with the state. This is the pattern running through all 5 states. The federal court closed the front entrance. State legislators left the side entrance wide open, and the people walking through that side entrance are the ones who were aware the rule existed to begin with. Mostly investors, and almost never the senior whose equity is sitting in an escrow account waiting to be claimed. A 2-minute phone call to your county auditor asking whether your name appears on any surplus list from a tax sale in the past 2 years resolves this issue in Minnesota. But it is the kind of call almost no one makes because almost no one knows it needs to be made. Now move from Minnesota to Nebraska, which had one of the most severe equity stripping mechanisms in the country prior to Tyler. The state operated a tax certificate sales system that allowed private investors to purchase a tax lien, hold it for 3 years, and then file for a tax deed, transferring complete ownership of the property to the investor. The original homeowner had the ability to redeem during that 3-year window by repaying back taxes plus interest at a statutory rate of 14%. So a $3,000 tax debt could balloon to over $4,500 before the redemption window closed. In one well-documented case from the late 2010s, a Nebraska homeowner lost a property worth nearly $200,000 over a tax debt of less than $6,000. The investor walked away with all the equity. The homeowner received nothing. Following Tyler, Nebraska updated its rules to mandate surplus return, but the certificate sale mechanism remains active. Investors still purchase tax certificates and earn statutory interest. The senior homeowner still has a redemption clock ticking against them the moment they fall behind on payments. The only change is that if redemption fails and the property transfers, the investor is now required to pay the surplus to the former owner. But the calculation of that surplus is where the $4,000 figure enters the picture. Nebraska statute routinely allows the county and the certificate holder to deduct what are referred to as recoverable costs from the surplus before it is disbursed. Those costs encompass attorney fees, title search fees, recording fees, and statutory interest accrued throughout the redemption period. In most Nebraska counties, those deductions average between $3,500 and $4,500 per case. So, a senior who is entitled to $20,000 in equity surplus may actually receive $16,000 or less once the deductions have cleared. That does not constitute theft in the legal sense. The Tyler ruling does not prohibit reasonable administrative fees, but for a senior living on a fixed income, $4,000 of equity disappearing into procedural charges can represent the difference between a year of in-home care and placement in a state nursing facility. The practical defense in Nebraska is therefore informational rather than legal. The state requires the certificate holder to send notices at multiple stages of the process, but those notices are written in legal language that most seniors cannot easily interpret. They resemble junk mail. They get discarded. The redemption window passes, the deed transfers. A licensed real estate attorney in Nebraska, at the typical hourly rate of $250 to $350, can review those notices and tell you within 15 minutes whether your property is at risk. That $50 to $90 a conversation can prevent the $4,000 surplus loss, and in some cases prevent the entire equity loss if the redemption deadline has not yet expired. There is also a Nebraska-specific filing called a homestead exemption that for property owners over 65 with limited income reduces the assessed value of the home, or in some county programs defers the property tax bill entirely until the property is sold or ownership is transferred. The deferred amount becomes a lien on the property, but that lien sits behind any first mortgage and does not accumulate interest at the higher statutory tax rate. A senior who is struggling to cover property taxes can therefore apply for the deferral, avoid the certificate sale process entirely, and preserve the equity inside the home. The homestead application is submitted to the county assessor, carries no cost in most counties, and can be completed in a single visit to that office. But very few eligible Nebraska seniors take advantage of it because almost no one tells them it exists. Adult children are generally unaware of it. Tax preparers typically do not know about it. The county assessor is aware but is not legally required to volunteer that information. And so the application goes unused while certificate sales continue across the state. Now move east to New Jersey, where the mechanism operates differently, but the equity loss is even larger. New Jersey routinely carries the highest effective property tax rate in the nation. The average homeowner in counties such as Bergen, Essex, and Union pays between $12,000 and $18,000 per year in property taxes on a single-family residence. For a senior who paid off the mortgage 2 decades ago, that tax bill is frequently the largest single expense remaining in retirement, exceeding even healthcare costs in many situations. That is the foundation. Now consider what unfolds when a senior in one of those counties falls behind on payments. New Jersey operates what is known as a tax lien sale, similar in structure to Nebraska's system, but with a critical distinction. The interest rate on a delinquent tax line in New Jersey can climb as high as 18%, plus an additional 6% penalty on the original balance. A $5,000 property tax shortfall can therefore grow to over $6,500 within a single year, and to over $10,000 within 3 years. But the more significant danger in New Jersey involves something called the abandonment doctrine. Under New Jersey statute, if a municipality determines that a property has been abandoned, the lien holder can initiate an expedited foreclosure action that compresses the redemption window from 2 years down to as few as 45 days. The definition of abandoned is applied loosely. A senior who relocates to assisted living and leaves the home vacant for 90 days while the family deliberates about whether to sell can have the property declared abandoned by a code enforcement officer, and the foreclosure timeline accelerates accordingly. In the average New Jersey tax foreclosure involving a paid-off senior home, the surplus owed following Tyler can range between $20,000 and $50,000. But the deductions permitted under New Jersey statute include attorney fees that in expedited foreclosure proceedings often run between $3,000 and $4,000 per case, along with lien interest, the statutory penalty, and the municipal administrative charge. The $4,000 equity loss in New Jersey is therefore nearly guaranteed. The defense in New Jersey is preventive rather than reactive. There is a New Jersey statute called the Senior Freeze, previously known as the Property Tax Reimbursement Program, available to homeowners over 65 with household income below the annual cap. That cap is revised each year by the Division of Taxation, so confirm the current threshold before submitting an application. The Senior Freeze does not eliminate the property tax bill. It locks the bill at the level it was during the first year of qualification, and the state reimburses the homeowner for any increase in subsequent years. A senior whose property tax bill rises from $12,000 to $15,000 over 5 years therefore receives a reimbursement check from the state for the $3,000 difference annually. The Senior Freeze application is filed directly with the New Jersey Division of Taxation with no application fee attached. The significant catch is that the application must be submitted every single year without exception. Miss 1 year and the freeze resets at the new and higher base amount. A senior who qualifies in 1 year at $12,000 and fails to file 3 years later has the freeze reset at the elevated level, which is frequently $2,000 higher than the original. But the program carries another structural catch. The state provides the reimbursement, not the municipality. The municipality still bills the full amount each year. The homeowner pays it in full and waits for the state to send the difference. For a senior on a fixed income who cannot advance that cash, the program is effectively inaccessible. The senior continues paying the increasing bill, eventually falls behind, and the lien sale process begins. A New Jersey elder law attorney billing between $300 and $450 per hour can review your tax history and senior freeze eligibility in one consultation. The cost is roughly equivalent to 1 year of reimbursement received, which means the financial math works in the homeowner's favor almost immediately. Now move west to Illinois, which had prior to Tyler one of the most aggressive equity-stripping tax sale systems in the entire country. The state used a hybrid certificate and deed sale structure in which investors could acquire tax certificates, accumulate interest at rates that ran into the high double digits annually in certain counties, and convert those certificates into full property deeds once the redemption window closed. Cook County, which contains Chicago and accounts for the majority of Illinois property values, was the center of this activity. In a series of well-documented cases, Illinois homeowners lost properties valued between $150,000 and $400,000 over tax debts as small as $4,000. The investors collected the full property value. The homeowners received nothing. Following Tyler, Illinois rewrote its tax code to mandate surplus return, but homeowner advocacy organizations have characterized the rewrite as insufficient. Specifically, the Illinois statute routinely allows the certificate holder to recover collection costs, attorney fees, and statutory interest before the surplus is dispersed to the former owner. In Cook County, the average deduction in a post-Tyler case runs between $3,800 and $5,200. A senior entitled to $30,000 in surplus may therefore receive approximately $25,000 after deductions are applied. That is the $4,000 equity loss playing out in practice. The defensive filing in Illinois is therefore the Senior Citizens Homestead Exemption, available to homeowners over 65 who occupy the property as their primary residence. The exemption reduces the equalized assessed value of the home by a fixed amount that differs between Cook County and the rest of the state. The actual tax savings depend on the applicable local tax rate, but commonly fall between $400 and $700 per year. The more powerful filing, however, is the Senior Citizens Real Estate Tax Deferral Program. Under this program, an Illinois homeowner over 65 with household income below the annual cap can defer payment of property taxes entirely. The deferred amount becomes a lien on the property at a low statutory simple interest rate, and that lien is settled when the property is sold or ownership is transferred. The deferred lien sits behind any first mortgage but ahead of unsecured creditors. The senior therefore never falls behind, never enters a tax sale, and never loses $4,000 to surplus deductions. The deferral application is typically filed with the county treasurer in the early months of the calendar year, and the filing fee in most counties is $0. Very few eligible Illinois seniors use the deferral, however, primarily because the program receives minimal publicity, and most seniors associate deferred taxes with future complications for their heirs. The reality is the opposite of that concern. The deferred lien accruing at a single-digit statutory rate is significantly more favorable than the far higher statutory interest charged on a delinquent tax lien. And the lien is structured to be retired cleanly at the time of sale or inheritance, with no unexpected penalties attached. The deferral therefore protects the senior throughout retirement and protects the heirs from a forced sale at auction. There is one additional Illinois-specific matter worth raising. Cook County has a separate disabled veteran standard homestead exemption that can substantially reduce the equalized assessed value for veterans with a service-connected disability rating above a defined threshold. That exemption is in many cases transferable to a surviving spouse, but it requires annual recertification with the county assessor in numerous situations. The recertification form is mailed to the address on file, which means the same address change problem identified in Minnesota reappears here. A senior who relocates to assisted living and allows the form to sit unopened can lose an exemption worth thousands of dollars annually. A licensed Illinois elder law or property tax attorney can assess your eligibility for all three programs in a single consultation, and the cost of that consultation is recovered in most situations within the first year of correctly filed exemptions and deferrals. Now move east one final time to Massachusetts, which is the most active state on this list because the equity tax conflict there is unfolding right now in real time. The state has a long-standing property tax cap statute called Proposition 2-122, which restricts annual property tax increases to 2.5%, plus new growth generated by new construction. For decades, that cap shielded homeowners from rapidly escalating tax assessments. But over the past several years, a number of Massachusetts municipalities have moved to override Proposition 2102 through a mechanism called the override vote. An override is a ballot question presenting local voters with a request for authorization to raise property taxes beyond the cap in order to fund a specific project, which is often a school, public safety facility, or infrastructure improvement. In many Massachusetts municipal elections in recent years, override votes have achieved majority approval at the ballot. That pattern of majority approvals triggered a recent wave of national attention because it means that in any given override election, the likely outcome is higher property taxes. For a senior living on a fixed income in a town where an override passes, the resulting bill can rise by $1,000 to $4,000 per year. The equity loss in this scenario is not a taking in the Tyler sense. It is a gradual drain through annually increasing tax bills that the senior cannot prevent because the senior represents a minority of the electorate. But there is a separate Massachusetts mechanism that raises greater concern. Several municipalities have begun exploring what is informally referred to as the unrealized equity tax, a property tax surcharge applied to the appreciated value of a home above its original purchase price. The mechanism is being modeled on similar proposals emerging in other parts of the country. None have passed in Massachusetts as of early 2026, but discussions are actively taking place in town meetings and legislative committees, and homeowner advocacy groups are monitoring the situation closely. If an unrealized equity tax were to pass in even one Massachusetts municipality, it would establish a precedent with the potential to spread. A senior who purchased a home decades ago for $150,000 and watched it appreciate to $700,000 would owe tax on $550,000 of unrealized appreciation at even a 1% rate. That amounts to $500 per year. Due in cash on equity the senior has not yet accessed or converted to income. The defensive filing in Massachusetts is therefore the Senior Circuit Breaker Tax Credit, available to homeowners over 65 whose property tax bill exceeds a defined percentage of their annual income. The credit is capped at an amount that is updated annually and is filed with the Massachusetts Department of Revenue as part of the standard state income tax return. There is no application fee. The credit is refundable, meaning that if the senior owes no state income tax, the credit is paid out directly as a check. But the more consequential filing is the local property tax exemption for seniors over 65, known as Clause 41, which is available in most Massachusetts municipalities. The amount varies by town, ranging from several hundred to a few $1,000s per year, and the application is filed annually with the local Board of Assessors at no cost in most cases. The combination of the circuit breaker credit and the Clause 41 exemption can therefore offset between $2,500 and $4,400 of property tax annually. Now I owe you the answer to the question I raised at the beginning of this video. There is one filing available at a county or town office for under $70 in most jurisdictions that quietly neutralizes the worst of the equity stripping mechanism in 4 of the 5 states I just walked through. That filing is a homestead declaration. In Massachusetts, it is called the Declaration of Homestead. In Illinois, it is the Senior Citizens Homestead Exemption. In Minnesota, it is the Homestead Classification. In Nebraska, it is the Homestead Exemption. New Jersey is the only state on this list that lacks an equivalent statutory homestead protection of comparable scope. The Homestead Declaration is a straightforward county-level filing that designates the property as your primary residence, and in most states shields a defined portion of the equity from creditors and forced sale. In Massachusetts, that protection commonly extends into the hundreds of thousands of dollars. In Minnesota, it covers a substantial amount of equity for a primary residence situated on a smaller lot. The filing fee in most counties typically falls between $35 and $75. Here are 5 steps to take this week before any of these mechanisms affect you. First, determine whether your state appears on this list. If you reside in Minnesota, Nebraska, New Jersey, Illinois, or Massachusetts, your exposure is at its highest. In other states, the same defensive filings exist under different names, and the senior homestead exemption is the most common starting point. A licensed real estate attorney or county assessor can confirm eligibility within 15 minutes. Second, file the homestead declaration in your county or town. For most seniors in the four eligible states listed above, this is the single highest yield filing available. It costs under $75 in most jurisdictions. It is permanent for as long as you own the property, and it commonly carries through to a surviving spouse automatically. Third, request a copy of your most recent property tax assessment from the county assessor. Compare the assessed value against recent comparable sales in your neighborhood. If the assessed value exceeds the current market value, submit an abatement application. The filing fee is typically zero, and a successful abatement commonly reduces the annual tax bill by between $400 and $200. Fourth, determine whether your state offers a senior tax deferral program. Illinois, Nebraska, and several other states allow homeowners over 65 to defer property taxes entirely, with the deferred amount becoming a lien at low statutory interest that is paid off at the time of sale or inheritance. The deferral can therefore protect the senior throughout retirement and shield the heirs from a forced auction sale. Fifth, schedule a single consultation with a licensed elder law or real estate attorney in your state. The typical fee runs between $250 and $450 per hour, and that consultation can cover homestead filing, tax deferral eligibility, surplus claim procedures from any prior tax sale, and the family transfer mechanism that safeguards equity in the event of incapacity. One consultation commonly recovers more than its own cost within the first year of correctly filed exemptions. The mechanism operating across all 5 states is the same. Equity is not taken in a single transaction. It disappears through a slow and steady drain of fees, deductions, and missed filings. The defense is therefore a collection of small filings, each typically costing under $100, that together protect the $4,000 or more that would otherwise be absorbed into the procedural pipeline.